Traders cannot afford to give in to feelings of excitement, fear, or greed when trading, as it can cause costly and irreversible mistakes. Overconfidence bias. Lesson number 1 in Forex trading psychology is to watch out for trading euphoria. Humans are naturally self-focused. Our egos want to be validated by proving that we know what we are doing and that we are better than the average person. Any hint that confirms these thoughts only reinforces our self-image by a distinct feeling of self-love. The problem is that this is where traders are most likely to succumb to overconfidence bias. It's not uncommon for traders to complete a winning streak and then believe that they can't get anything wrong in the future. To believe this is of course unwise, and is only getting to end in failure. Make sure you always analyze your trading sessions and look at your wins and losses in detail. This is the only way you can really stay on top of your trading. Allow yourself to make mistakes and don't make the mistake of being scared to prove yourself wrong. You'll be in a much better position for it in the long run. You have to be comfortable with accepting that mistakes are inevitable, especially in the early stages. It's all part of the learning curve. Anchoring bias. This one is about mental comfort zones created by traders when performing market analysis, ultimately thinking that the future will be the same as the present, purely based on the reason that the present appears to be like the past. Just as with other biases in Forex trading psychology, this one is directly borrowed from social studies. Anchoring is a tendency to rely on what is already known to a trader for decision making in the future, instead of considering new situations and the changes that they can bring. At times, anchoring trends can cause traders to rely on obsolete and irrelevant information, which of course won't help them to trade successfully. In practical terms, this manifests itself in traders holding losing positions open for too long, simply because they fail to consider the options that are outside of their comfort zone. You must not be afraid of trying new things when trading Forex. Be willing to try new strategies, like trying out trading signals. In our last video, we used signals from a site called Tools Trades, which you can check out in the description. Confirmation bias. Confirmation bias is the one factor that is most common amongst professional traders. Looking for the decision you have made, even if it wasn't the best decision, is simply a way of justifying your actions and strategies. The problem is that by doing this, you're not actually improving your methods, and you're just going to keep making the same trading mistakes. Unfortunately, this can create an infinite loop in Forex trading psychology that can be difficult to break. The best case scenario in confirmation bias is that a trader will simply waste precious time researching what they already knew to be true. However, the worst case scenario is that not only will they lose time, but also money and the motivation to trade. A trader must learn to trust themselves and be happy to use their intelligence to develop profitable strategies and then be able to follow them without fear or doubt. Loss aversion bias. Loss aversion bias derives from the prospect theory. Humans have a funny way of evaluating their gains and losses, along with comparing their perceived meanings against each other. For example, when considering our options before making a choice, we are more willing to give preference to a lower possible loss over a higher possible reward. Fear is a much more powerful motivator than greed. In practice, a trader with a loss bias is more akin to cutting profits when they are still low while allowing bigger drawdowns. A much more powerful motivator than greed. In practice, a trader with a loss bias is more akin to cutting profits when they are still low while allowing bigger drawdowns. If you liked the video, be sure to subscribe, like and share. May the Forex be with you.